In the last few days, a dramatic political and economic story has unfolded in the United States. President Donald Trump fired the head of the Bureau of Labor Statistics, the agency responsible for producing the country's official jobs data. The decision came shortly after the release of a disappointing jobs report that showed the U.S. economy adding far fewer jobs than expected. According to the report, only 73,000 jobs were created in July. Economists had been predicting a number closer to 175,000 or more. On top of that, the figures from May and June were revised downward, revealing that the economy had actually added 258,000 fewer jobs in those months than originally reported. The combination of weak new numbers and downward revisions painted a much gloomier picture of the job market than the White House had been projecting. The president reacted quickly and forcefully. On social media, he accused the commissioner of being politically biased and claimed the numbers were rigged to make his administration look bad. He announced that she was being removed from her position effective immediately. This type of public and sudden dismissal is rare, especially for an official responsible for independent data collection. The Bureau of Labor Statistics has long been viewed as a neutral, professional institution. Its job reports are relied upon by businesses, investors, policymakers, and even foreign governments to understand the health of the U.S. economy. By questioning the credibility of the data and firing its leader, Trump has sparked a debate over whether political leaders should interfere with independent statistical agencies. At the same time as this political drama, U.S. financial markets were already on edge. Just days earlier, Trump had announced a new wave of tariffs on imports from multiple countries. These tariffs, essentially taxes on foreign goods, were part of his broader trade strategy to protect American manufacturing and reduce the trade deficit. But they also had an immediate impact on investor confidence. On the morning the jobs report came out, the stock market reacted sharply. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq all dropped significantly. By the end of the day, it was the worst single-day performance since May. Investors were digesting not only the weak jobs data, but also the potential negative effects of the new tariffs. The combination of slower job growth and higher import costs fueled fears that the economy might be headed toward a slowdown. Tariffs can help protect domestic industries, but they can also raise costs for businesses that rely on imported materials. Those higher costs often get passed on to consumers, adding to inflation and reducing spending power. For ordinary Americans, this news is not just about numbers on a report or fluctuations in the stock market. Job growth affects real lives. Fewer jobs mean tougher competition for available positions, slower wage growth, and more uncertainty for families. Inflation, which has been a concern in recent years, can make everyday items more expensive, from groceries and clothing to cars and electronics. Trump's supporters argue that his decisive action shows leadership. They say that if the jobs data was inaccurate or politically motivated, the person in charge should be held accountable. They also believe that tariffs are necessary to rebuild American industry and stop foreign countries from taking advantage of the U.S. in trade. From this perspective, short-term economic pain is worth it for long-term independence and stability. Critics, however, see the situation differently. They warn that firing an independent data official over an unfavorable report sets a dangerous precedent. Economic data must be trusted, even when it delivers bad news. Undermining that trust could damage America's credibility with investors, businesses, and international partners. They also caution that tariffs may slow the economy and harm American consumers by raising prices, adding to the uncertainty. The Federal Reserve is now in the spotlight. The resignation of a senior Fed official, Adriana Kugler, has given Trump an earlier-than-expected opportunity to reshape the central bank's leadership. The Fed is responsible for setting interest rates, and with economic signals turning negative, there is growing pressure for rate cuts to stimulate growth. However, there is also concern that political influence over the Fed could undermine its independence and long-term credibility. Economists are divided on the path forward. Some believe that the U.S. economy is fundamentally strong and can withstand short-term turbulence from tariffs and leadership changes. Others fear that the combination of slowing job growth, higher trade barriers, and shaken investor confidence could tip the economy toward a recession. The situation has also drawn international attention. Other countries watch U.S. jobs reports closely because America's economy is deeply connected to the global market. A slowdown in the U.S. can reduce demand for foreign goods, disrupt supply chains, and weaken global trade. Foreign investors are also sensitive to political moves that could impact market stability. For small businesses in the U.S., the news brings mixed feelings. On one hand, they may benefit from reduced foreign competition if tariffs protect certain industries. On the other hand, the firing of the Bureau of Labor Statistics head has also sparked a broader conversation about the role of data in a democracy. Reliable statistics are the foundation of sound policymaking. When citizens and leaders lose faith in the numbers, it becomes harder to agree on solutions. That's why many experts believe it's dangerous to politicize economic reporting, even if there are legitimate disagreements over methodology or interpretation. Meanwhile, on Wall Street, traders and analysts are recalibrating their expectations. Bond markets have reacted by pushing yields lower, signaling that investors are seeking safer assets. Some analysts now predict that the Federal Reserve could cut interest rates as soon as September to offset the slowdown. Rate cuts can encourage borrowing and investment, but they also come with risks, especially if inflation remains a concern. For everyday people, the situation can feel far removed from daily life, yet its effects are real. If markets remain unstable and job growth stays weak, it can affect retirement savings, mortgage rates, and even local job opportunities. Economic confidence plays a big role in whether people decide to spend money, buy homes, or start businesses. Trump's actions in this case, both the firing of the economic official and the imposition of tariffs, reflect his broader governing style. He often makes bold public moves intended to demonstrate control and shake up established systems. Supporters see this as a sign of strength. Critics see it as a risk to stability. Looking ahead, much will depend on the next few months of economic data. If job growth rebounds and markets stabilize, Trump supporters will claim his tough approach was justified. If the slowdown worsens, critics will point to these decisions as having deepened the problem. Either way, this episode highlights the delicate balance between politics and economics. In a complex, interconnected world, every move from a change in tariffs to a personnel decision can send ripples through the entire system. Managing those ripples requires not just bold action,